This video is about estimating returns from REITs and InvITs and how to do the calculations correctly and in a manner which is relevant for decision making. So if you look at the Nifty returns for 5 years, they are an approximately 65% return for a 5-year period. Similarly, the Embassy REIT gives a return from the IPO to now approximately a 30% return. Now, both these slides do not reveal the correct as well as relevant information. Why? Firstly, the 3-year Embassy REIT is not really 30% return, it's actually 55% return, and that is what we would come to, the correct estimation. And the second is that when you are comparing that a 5-year Nifty is giving you 65%, whereas the 3-year Embassy return gives you 35 or 30% or 55%, how do you compare the two in respect to unequal time frames? So the two main factors we need to understand is that for the correct estimation, all payouts, all distribution types, whether they are interest or they are return of capital and so on, they need to be incorporated in the calculations. And secondly, there has to be an annualized return so that you can compare between two different assets or two different REITs or two InvITs or so on. As we have explained in our earlier video, which was released on 12th May 2022, a typical return from REIT is around 12 to 15%, out of which a large portion happens to be the return from properties, which comes in the form of rentals or revenues. That comprises about 7 to 8%, and there is a price appreciation component of 5 to 7%. And this is what needs to be incorporated, the recurring returns, which are quite often missed out in case of a Nifty or in regular stocks, because that's a very, very small component. So we tend to ignore it. Let us take the case of Embassy REIT itself, because that is a REIT which has been there for a longer time compared to other REITs. And if we see the total returns, they comprise of two components. One is the recurring return, which is coming to around 67 rupees 63 paise, which has been paid over a period of 3 years. And the second component is the price appreciation, which is approximately 100 rupees on a given date that we've chosen. And now if you really see it, this is 40% is recurring return out of the total amount which has been received in Embassy REIT, and 60% happens to be capital gains. So we really cannot ignore this as in case of regular shares, the recurring return part. The second thing that needs to be done to estimate returns is to put the figures into something that is relevant. For that, it is important to do an annualized return. What is it that comes on an annual basis? And with respect to that, there are 3 methods of doing this, which we will discuss. The first is a simple percentage return. The second is compounded returns. And the third is the use of spreadsheets by the extended internal rate of return. To understand this, a conceptual example is given with an yearly return of 10% per annum, which has been assumed. And viewers can just pause here and see a very simple example of how simple percentage returns, compounded returns are calculated for the people who are unfamiliar with this. How we will calculate in our case is by these 3 methods. So the first one is by returns per year. We would divide the returns by the number of years. As an example, if the returns are 60% and the years are 3, then 60% divided by 3 is equal to 20%. For the second method, the CAGR method, we would incorporate this as a root of the by the number of years. For example, if it's 3 years and 60% is the total return, the cube root of 60% is taken. And the last method would be the XIR, or the extended rate of return method, which we can do with using spreadsheets. And here all cash flows, including all payouts, are annualized, and all date-wise cash flows are incorporated in this calculation. We will take the example of Embassy REIT and do all these three calculations now, and for the sake of simplicity we will assume two things: that we will ignore taxation and we will ignore reinvestment of distributions. So the time frame is 3.25 years, the buy rate is 300 and sell rate is 400, and the payouts in 3.25 years is 67.63 rupees. So in the simple interest method, a percentage gain is calculated as 167.63 divided by 300, which is 55.88, and this is for 3.25 years. So yearly gains become 55.88 divided by 3.25, which is 17.19%. Then in case of simple returns, percentage returns, we have already seen that we have already incorporated the payouts also. The next is the compounded annual growth rate, or the CAGR, and the reason to use it is because it's a more accurate measure than simple percentage returns, because it takes into the effect of compounding also. So the basic concept remains the same. So it's the number of years root of the returns. That's what we had just discussed. And the formula is in fact a little more elaborate, as ending value by beginning value raised to the power of 1 divided by number of periods minus 1. So if we see the application in our case here, in case of Embassy REIT, it becomes 467.63 divided by 100 raised to the power of 1 divided by 3.25 minus 1 is equal to 14.64%. Now, if you recall, simple interest was at 17.19% because the impact of compounding was not accounted for in case of simple percentage returns. In CAGR, it is a year-on-year return. The last method would be the XIRR formula, and this is used widely by professionals, and it can look a little bit complicated for people who are new to financial calculations. So you can really look at some great websites like tvmcalcs.com. The snapshot is given below, and understand it, but we are going to explain the XIRR formula briefly now. So the XIRR formula basically means the extended internal rate of return. It's a complex compounding calculation which is done taking into account dates also, and each cash flow according to the date, and it can be easily performed by use of spreadsheets. So the steps are: firstly, we list all the dates when cash flows happened. Then we list out all the cash flows beginning with the investment amount and assuming that the last value is the sale date. In between these outflows and inflows, there are all payouts irrespective of the category, whether it is dividend or it is interest and so on. And then the formula is applied as required. So the next slide here would show the spreadsheet calculations, and you can all pause here and see, and people who know it would already be familiar with how to do this. Otherwise, I've already given a link to TVM Calc so you can understand the concept there better, and then come back to this slide again. So as a conclusion, what we have here is that we, after getting the correct data where all payouts are added, we move on to getting relevant data where we annualize with 3 of the methods, which are either simple, compounded or XIRR method, and then you get the final or the correct and relevant output. And for a quick estimate for people who don't want to get into the XIRR formula, please notice here that the XIRR calculation result is somewhere between the first 2 methods. So that could be a quick estimate of what an XIRR formula could yield.